Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
So Daniel, Mom and I have been kind of binging on one of these detective murder mystery shows and whatnot, and there's one guy on there that is the head guy, and when it comes to different cases that they're working on, he gets these gut instincts that really drives the whole team, and of course he's usually right with that gut instinct, and from that angle, that just reminds me when I have people come in and we're talking about their finances, I'm asking them, I want to know, with it's women, I want to know women's intuition, because I really believe in women's intuition and the value of that. And then, with guys, it's like more of a gut instinct and what's their gut telling them about things. Today as we talk, I think we should be talking about, what is your gut saying to you? Because there's some value in that.
Yeah, I like that idea. People's gut instincts, especially with as crazy as what's happening in markets these days, is very important. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. We're glad to have you on with us again this week. And, this whole thing, why we spend all this time doing this show, podcast, is because people don't know what people don't know. And if there's nobody to tell them the things that they don't know, then they become ignorant and are remaining ignorant and aren't able to make the decisions that they need to be able to make. So, Daniel, this is really something, right? When we're talking about instincts and gut and what's going on, right? Because I have a lot of people coming in these days that are concerned. Their gut's telling them that there's issues in the markets, in the stock markets right now, in our world right now, and they don't want to put their money at the risk that the money was. They made money in the stock market. They've done a lot of things, and they may still be enamored with the market in certain ways, but they also are saying, hey, I need to diversify. I need to have some other monies doing other things for me besides just these stocks.
Yeah, it's as we get older, right? As we get to different places in our lives, we're less aggressive on certain things, right? And I think people with investing feel that, but the difficulty is there's not a lot of people talking about alternatives. There's not a lot of people talking about different ways of doing it. If you turn on any of the financial news organizations, they're not even talking about investing, period. They're talking about trading, right? They're talking about what your portfolio will do next Tuesday. Jim Cramer's over there getting on the bandwagon late for everything. It's like it's a difficult place for people to find valuable information that's useful for investing for a long term and for generating especially income for people who no longer are working or thinking about retiring.
Daniel, you're always giving us that beautiful definition of what a true investment is. I don't have it off the top of my head. Please tell us.
It's an investing in something that will pay you, right? So if you buy Tesla stock, you hope that it's going to go up, and until the last 6 months, it's gone up tremendously. And that would have been nice if you jumped on the bandwagon early before Jim Cramer, right? But now it's at these crazy valuations, and maybe in 20 years it will be multiples higher. But that's a hope. You're hoping that it will be higher, that they'll continue to innovate, that they'll figure out autonomous driving, that they'll be the provider of batteries, right?
Right.
But it's not paying you anything.
Yeah.
And so that's a speculation compared to if you find one of these companies. There's plenty of them. You were just telling me a story about a client who's buying a company, right?
Right.
And they're getting a wonderful valuation because they're not doing what everybody else is doing.
Right.
And so you find these companies that are making tons of money, that for whatever people aren't looking at them because they're not sexy, and it's paying you. So you know what you're going to earn. That's the income, right?
Yep.
The I. And
Right.
then you can get appreciation too, because as
Mhm.
people start being less enamored with stuff like Robinhood, where it's down 75% in the last 6 months, right? Uh, Netflix is down like 35%.
Wow.
Facebook crashed 20% in one day. Right when people stop being enamored with some of these stocks, money, and
Right.
it already is going into some of these other investments that are already paying you, and this rotation is already happening. But the most important thing when you're retired is that
Yeah.
the company's paying you.
Yeah. So the definition of an investment is being paid,
It
using your
has to
money to
pay
get
you.
paid. Has to pay you. Okay, great, great. That's really good. And so when we look at, you just mentioned a bunch of companies that are down, uh, significantly, right? 10, 20, certainly double digits, big time double digit stuff, depending what it is. And then we have the what do you call it? The S&P 5, 6, 7. What is that you say?
Yeah, well, the S&P 500 is the 500 largest stocks in
Yeah,
the U.S., right?
yeah,
And
yeah.
lately, it's been the S&P 7 because there's seven companies that are driving that are leading to it going up. And two of those stocks I mentioned, Facebook and Netflix, they got hammered. They're both down 35+% over the last 6 months.
Ouch.
Does that sound like gut check? Does that sound like you as a retiree? You want your money in something like that. These seven stocks have been holding up the S&P. Those are two of them. What happens if the other ones start having these kind of issues?
Well, isn't one of the other ones Tesla? What are the other ones?
Tesla, Google, Apple, Amazon, Netflix, Microsoft, Facebook.
Okay, so didn't is Tesla up right now? Is Tesla down right now?
Well, it's down from its highs for sure. Tesla's a
Okay,
very volatile one. Yeah.
okay, all
Uh,
right.
um, but the fangs, right? The fangs, which
Yep.
people talk about all the time, they
Mm-hmm.
don't include Microsoft and Tesla, but Microsoft and Tesla have both been huge contributors to the S&P 500. They make up a huge portion because the S&P 500 is not equally weighted between 500 stocks. It's based
Right.
on market cap. So the bigger your market cap, the larger percentage of the S&P you make up. So those seven stocks are a tremendous, like something like 30% of the S&P 500.
Wow. And so all those other things with it in the S&P 500, maybe they're down, maybe they're not down, but I know that you've talked in the past about when you're looking at the valuations of those companies, that their debt, a lot of them are in debt. And just like holding on because of the FANG stocks and such, the S&P 7 pushing everything up. That when it all comes out, when the tide goes out, all the ships go down. So when that happens, that not only will those things go down, but they'll go out and they'll potentially sink. Right? There's a lot that are in that category at the same time.
Yeah. Um, a lot of these stocks, if you looked at the other, call it 493 stocks, you know, some of them are good, but they look like they're already in a bear market. They look like they've been in a bear market, and we've had these these huge market cap stocks, right? These $1 trillion companies holding it up, and and do you think that will continue? Like, is Apple a good company? Yeah, absolutely. It's a wonderful company, but like, do you want to depend on them to keep it doing basically financial engineering because their revenues haven't really grown since 2015. Okay, their
Wow.
price per share has because
Yeah.
they're financial engineering. They're taking this money they're earning and they're buying back shares, so there's less shares. And then the multiples, because people keep saying this is the biggest, best company ever created, keep putting money into it. So we were buying Apple right at an 8 to 12 price per earnings, and now it trades somewhere around like 40. So like
Wow.
their earnings didn't necessarily go up, but people were willing to pay more, which drove the stock price up.
Yeah. That's crazy. It sounds like people have a need to have some financial defense going on, right? Because financial defense wins championships, right? And so, I'm thinking of, if you've just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And today's topic is, what does your gut say? And we have a paper that we'd like to put in your hand. It's called The Importance of Financial Defense, which will give you some indication of how to prepare and how to be able to look ahead for making sure that you don't run out of money in your lifetime. So you can have that by calling us at 800-725-7616, 800-725-7616. So Daniel, when we're talking about all these different companies that, an SP 500 and how that doesn't look, things are not necessarily in favor right now. If you look at the history of the S&P just for this past year, and we're down significantly right at this point in time compared to as far as off the high goes. And there's been some volatility in there. Some people think that there hasn't been a lot of volatility, but there's been some, not as much as other years. But things adjust, right? Trees don't always keep growing, right? Because we'd have a zillion trees to the moon and whatnot, and so. How does all this fit in with people as they look toward retirement and preparing for retirement?
Well, we talk to people. You talk to people every day, and they feel something is amiss. They feel something is awry. When you're young and you're putting your money into the S&P 500, it works really good, or the Nasdaq, it works really good. And when markets come down, great. That's a buying opportunity. And you don't really check your accounts, right? You don't really look at your accounts. And when you do, it's kind of up. But is it up because the thing went up, or is it up because you're putting money into it every month? And then you wake up, 20 years later, and it's performed very well.
Right.
Even when there are periods of time like the 13 years where the S&P did nothing, it just got back to where it was, right? From 2000 to 2013. And even companies like Microsoft, they did nothing. Wonderful, wonderful companies. But if you were dollar cost averaging, that benefited you. And when you look 13 years later, even though it was flat, you made money.
Right.
But when you retire, it works in reverse. So if it's not paying you, you're cannibalizing your principal.
Yeah. Exactly. And that's one thing that, people as they get older, they're in their 50s, maybe they're 60 years old, 62, 63. They're still away a little bit of time before they actually retire, and they think, well, I want to still squeeze whatever growth I can get out of this. I want to squeeze it out of that, and they are blinded to the fact that there's ways of getting growth, and there's ways of growing your money besides just doing what every Tom, Dick, and Harry does, for instance, or what the rest of the herd mentality does. And that is what I think, I'd like to try to communicate to the people in our listening audience, from that standpoint, that there's other ways of making money. And sure, the stock market has done stuff. The stock market will continue to do stuff. You'll be able to make money in the market. And I want to make it very clear that the market has its place in diversification, but you need to have diversification because there's always things that happen. And, I like the Ecclesiastes from the book of Ecclesiastes in the Bible, 11:1-2, cast your bread upon the water. After many days it will come back to you, given under 7 portions, even 8, for you don't know what disaster will come upon the land. So you need to diversify, and putting all your money in the stock market is not diversifying. As a matter of fact, it's on the verge of, if not even right in line with gambling. And gambling is not investing. It's a whole different thing. And I want to be able to talk to people about that when we get back from break. It's time for us to take a break. But before we go, I want to let you know that you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, what does your gut say? And we're giving away a book that we'd love to put in your hands by Howard Marks, called The Most Important Thing. The most important thing, we've got a quote coming up from Howard Marks. And so you want to stick around to be able to hear that, to be able to give you a little bit of taste of that book. And you can have that book by calling 800-725-7616, 800-725-7616. And we'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, Marty came in not so long ago. And as you know, Marty sold his business and he's got a great amount of cash sitting in the bank right now. And looking at his portfolio, and he said, Andrew, I read the book that you guys have. And I understand that you're doing all these different things, and I want to diversify. I want to come along. I need a professional risk manager to help me with this, because I'm very good with the stock market. I've done really well with the stock market over a period of time, but right now I'm very concerned. My gut is telling me that I need to be out of the market. So right now I got about 75% of my cash, of my money in cash. And I know that's not good, because I'm being a poor steward. I mean, I'm losing money because of inflation and whatnot. So, but I don't know what else to do. And I know you do, because you're a professional at this. So, help me. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about what is your gut telling you. And that intuition is an important thing. Our brain subconscious gathers up all this information without us even knowing it's happening. And then that's where that gut feeling comes from, right?
Yeah.
It's not just a whim. It's all your knowledge that's compound over time, and it's picking up this stuff and it's telling you something.
Yeah.
You don't know exactly why, because our subconscious is 95% of everything that we do. Our conscious is only 5%.
Yeah.
And so that's why it's so important that people pay attention to what their gut is telling them. And there's this myth that you need to be fully invested, or you need to have cash,
Right.
or somewhere in between, right? The difficulty with that is, if you're fully invested in stuff like Facebook drops 20% in one day, how do you participate in that? See, we're not against making money.
Right. That's for sure.
But we want to make it at the right times. We don't want to do what everybody's doing. We want to
keep it.
Right. Right. So you're fully invested. You can't participate in that because you have to sell something else if you want to. Okay.
Right.
What about your lifestyle? Okay, so that the NASDAQ's down, 15%, 20%, whatever. What are you going to do? Are you going to put your lifestyle on hold, or are you going to have X amount of cash on the sideline? With inflation at 7%, that means you got a minus 7% yield. You going to do that? Well, you could do that. But now, not only do you have a minus yield on that, but you have opportunity cost, because if you just brought down your yields, if the NASDAQ is averaging 20% a year over the last 5 years,
yeah.
Well, you weren't fully invested. So what do you do? What's the answer? How are people supposed to do this? What did you tell your friend over there?
Well, I told him for income. Income is the key, because income keeps coming in no matter what. And you're always making money. And what's the definition of an investment? It has to pay you. So when you're receiving income, it's paying you, right? And so, with Marty there, he's concerned about that. He's in his mid-50s. He's not that old. He's not ready to retire. He's still got a lot of good years in front of him. Smart guy, real smart guy. Went to the Air Force Academy, was in the military for a period of time, and the guy knows a lot of good things, but he recognizes what he doesn't know, and he doesn't know how to invest for income in a way that will manage his risk. And, isn't that why people hire fiduciaries and people that are going to help them with investing their money, Daniel, to manage the risk?
It should be. I don't think it is now. I think they want somebody to pick stocks, to pick what's popular, to do what everybody else is doing, and you don't need a professional. You don't need an advisor to do that. And a
Right.
lot of these people that you go hire, like you go downtown Madison or whatever, work
Yeah.
at one of those. They're not fiduciaries. They're fiduciaries to their company.
Yeah.
And there's somebody in the organization who's picking diversified mutual funds that or ETFs that own the same stuff,
Right.
or it's an ETF, so you don't know what's in it, and it's volatile just like the market, because when you put stuff into a basket, when you put things that are illiquid, things that shouldn't be traded by the millisecond, like bonds, into a basket, then what happens? That makes that thing just as volatile, and you don't have control. If Jerry over there gets freaked out and sells his bonds,
Yeah.
you don't have the contract anymore,
Right.
right? Because the bond manager just had to sell Jerry's bonds,
Yeah.
give Jerry the money, but that means you sold at a loss when you didn't want to sell.
Yeah.
So those are good for young people who don't have any money. But once you've built your wealth, you want to own the individual company.
Yeah.
That way, you're getting paid. You're looking at the fundamentals, and you get to hold on to that because you understand the fundamentals are good, even if there's price volatility in the middle. And if it's a contract, like what we talk about investing in bond and bond-like instruments, you don't even have to worry at all, because at a certain date you're going to get your principal back.
So I think a lot of people think that if they don't, there's accumulation and growth, and then there's income, and they're opposites of each other. And they think that you can't get growth from income, and so they're not quite ready to stop growing their money, but they're not understanding it clearly, are they? That's not how it is. It's not one or income. You can have the best of both worlds. You can get your growth by reinvesting the dividends and interest, as well as share price growth. And that reminds me, you have a great story about Hercules, that deal with Hercules. But before you go into that, listen, if you just joined us, you're listening. I'm having a good time here today, man. I'm forgetting about the time and forgetting that we got people listening to us. So, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, what does your gut say? And we've got a paper that we'd like to put in your hand called The Importance of Financial Defense. So, a lot of people understand that defense wins championships, and the same thing happens with finances. So, importance of financial defense, you can have that by calling 800-725-7616, 800-725-7616. So, Daniel, tell us about, this example of, Hercules bond.
Well, we hear all the time that bonds are bad, right? Can't make money in bonds. And there's two types of bonds. There's government bonds and there's corporate bonds. There's lots of types of bonds, but I'm talking about two types of bonds, right? Government, which usually when people are referring to bonds, so when you hear the talking heads on all these TV channels talk about bonds, they're talking about government bonds, which are down tremendously right now. The price is down tremendously. The yields are up. So I think the 10 years around 1.9 right now, which is good, very good compared to what it has been over the last, basically since the Corona pandemic whole thing started, right?
Right.
When you buy a bond, you give a borrower your money, and in return for your money, they give you a certain amount of interest. That's a contractual guarantee. And at the end of the time, whatever time you pick, you get your money back. It doesn't matter what happens to the price in the meantime.
Right.
But what a savvy investor will do is they will look for companies that have good credit quality. So just like if you were going to lend your money out to a friend or lend your money out as an investment
Family member.
Someone, you'd want to make sure that the person you're lending that money to will pay you back.
Right.
So you look for companies that are credit worthy, that will pay you back, and you look for ones that are trading at discounts. Okay, so if I buy a bond, I pay $100 for the bond for 4 years. I get $100 back in 4 years. In the meantime, I collect my interest. Okay.
Mhm.
Well, if you get it at a discount, in the case of this Hercules bond we're talking about, this is a wonderful, wonderful company. They've done some really cool things. They have awesome investment management. It's a solid company. And we saw their bonds trading at a discount. So we could buy the $100 bond for $97,
Wow.
which increases our yield. So if it's got a 4.5% coupon on it, we're actually getting more like 5.5%
Nice.
in a yield, right?
Nice.
Well, there's
5.5.
also a kicker on this thing where it's a convertible bond. So if the company does better, not only will they pay you, no matter what, you get your $100 back.
Yeah.
Plus interest. But if
Nice.
they do good, you get a kicker on top of that. So we bought these things a couple of years ago, collected our dividends, and they came due just a few weeks ago. We didn't get $100 a bond for it. We didn't get $97 that we paid for it. We got $109 per bond.
Woo!
Okay.
Wow,
So
that's a home run. Yeah.
That's great. We got what we put into it back. Actually, we got 3% more than what we put into it back. We got our coupon, and then we got a 9% kicker on top, right?
Yeah, so that's like a growth rate of 12% plus the 5.5% or plus a 4.5% dividend or so every year that you've owned it. That's phenomenal.
And that's in a couple of years. Okay, so that's who's complaining about that kind of return? Now,
Safe. That's less than half the risk of the market. Yeah.
Oh, far less. Yeah, with a 2-year bond. Yeah. So this is the kinds of things when we're talking about alternatives. These are the kinds of things we're talking about. So it's not that stupid 1.9% return that people are that people think about, that the news media pushes out there. These are the kinds of things that we're talking about when you hire the right person to help you pick these things. Right. And that's an exciting thing. But it's even better than that, because 2 weeks ago, markets were selling off like crazy. There's a lot of fear, right? There's a lot of fear. Things are down. Yields are up. So we were able to take that money.
So it's kind of like selling high. It's kind of like selling high, right? Which you're supposed to do. Sell high, buy low, right?
So, but when do you ever have assets that are high when everything's selling off?
Well, we have it all the time.
This is how it happens because they bought it back for us at a premium.
Yeah.
We have cash that just can't. So we've been collecting our yield. You get to go buy your cars, live your lifestyle, go on your cruise, do whatever you want. You don't have to worry about market fluctuations.
Yeah.
Because you're getting interest. But then you get this inflow of cash into your account right when stuff's selling off, and we're able to reinvest that for even better yields. That's the way it's supposed to work.
Buying low. We sold high essentially to buy low, right? And that's the multi-million-dollar advice. A lot of people don't understand this stuff because they might have, $2, $3, $4, $5 million, but they got it just by, dumb money, as I call it, putting money, investing in the market along with the herd mentality. And, but to understand what multimillionaires do, you have to, go a step further. And that's what we're trying to bring across. If you just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Which hopefully, you're receiving a great education here. We're not entertainers as much as, we are educators. And so we're trying to educate you and be able to make smart decisions. So with that, we have a book that we'd like to put in your hand, help you continue in your educational process, by Howard Marks, called The Most Important Thing. And Howard Marks goes into helping you understand when it comes to investing, comes to risk management, comes to managing your money, you have to understand and focus on the most important thing. So we can have that book by calling 800-725-7616. And we're going to come back after break. 800-725-7616. See you soon.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
When you're accredited investor, bond investor, you shouldn't care that much if prices are going to go up or down, if you should buy or sell. We have the great luxury where the returns are contractual, meaning you give your money to the borrower. They promise to give you interest. They promised to give you your money back, and the returns are contractual. Your earnings don't come from the market. They come from your borrower, your contract with him. And you don't need to get excited about getting out in time and then getting back in time. This is a quote from Howard Marks. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about what's your gut telling you. And that quote is great. That kind of explains what we were just talking about with that Hercules bond, right?
Exactly.
I think such an important thing in there is saying your returns don't come from the market. Doesn't matter
Right.
what it's doing.
Right. And then another aspect I like about what he says is that, basically he says timing is not important, because people think that timing is important. But when it comes to this, this kind of investing, timing is not important. I mean, the biggest importance about the timing is doing it now rather than waiting, because the sooner you do it, that Hercules bond that you had talked about, that was something that happened a couple years ago. So people who were with us or had money with us in one way or another, maybe they were new, maybe they were existing clients, they were able to take advantage of that. And we don't have that today. But the key is today we're going to have things in a couple years that, we won't have then. And so the sooner people get involved with this, like our friend Marty that we were talking about, he wanted to get involved so that he can start participating, switch his strategy from all market, stock market approach to including the fixed income market as well as the stock market, and being able to diversify from that standpoint. And he wanted to do it now while there's still time. As I said, he's only in his mid-50s, but he recognizes, smart guy, recognizes the need to do it. Howard Marks, smart guy. He's co-founder of Oak Tree Capital Management, which just powerful company, right?
Investing for 50 years. Yeah, successfully investing for 50 years.
Guy knows what he's talking about. And that's the best way to be able to learn is from people who have other people's experiences. And this is a positive experience. And that's where we're learning from and being able to apply to our clients, which therefore becomes multi-million-dollar advice that, if you've just got, $1 million, $2 million, $5 million, whatever it might be, we can offer multi-million-dollar advice, even though you don't have, tens and hundreds of millions of dollars from that standpoint. So that's what's pretty exciting from my point of view, Daniel, when we read something like this from Howard Marks and we look at what we're doing for people and what we have the advantage to. I'm so glad that, people are listening to us today because they're able to get perspective that they're not going to get from those talking heads on TV, the entertainers that are out there. They're not going to teach, those entertainers are not teaching them stuff. They're just talking. And unless you can read in between the lines and study in between the lines, I mean, there's some things you can pick up, but there's a lot of things you're not picking up. And that's the dangerous stuff.
Right. Time frame is a vital factor. And so whenever somebody says something, right, a financial professional, a talking head, an entertainer, when they say something, you have to look at first, what are they doing? But then second, like time frames. Are they talking about trying to trade in and out of something where you're saying, I want to go on a cruise. I want to take my family on a cruise. I want to enjoy my retirement and not have to worry about if the NASDAQ's up 10 points or down 25 points, right?
Right.
Like what's your time frame? If you're talking about retiring and staying retired for 30 or 40 years, that's a totally different thing than trying to jump into US Steel and make $20 a share in, by next Tuesday, right? These are totally different things. So we're not talking to traders. We're not talking to people who want to do what everybody else is doing. We're not talking to somebody who's happy with, if everybody lost 60%, I'm okay losing 60%. We're talking about the intelligent investor who wants to protect themselves from the unforeseen events, right? Where they can be confident in their retirement and they get paid to have it. That, it makes me think about private investing. So like entrepreneurs will really understand this. So, you're a serial entrepreneur. There's people listening here who are entrepreneurs. And when you start a company, you build your company, it has a value, right? That's the growth of the company. It has that value. You're not checking it on a daily basis. You don't really care what it is. Maybe depending on the business, you're taking loans against the business value, but most don't even do that. What do they use? They use the income the business is generating to live, to reinvest, and to start or build other companies, right? We see this over and over. You've got all this cash flow, and what do you do with that? You go and you start another company. It didn't matter what your current company's value is. You don't care if it's worth $2 million or $20 million, unless you're selling it. You care about the cash flow. Then you go start another one. Yes, they both have an intrinsic value. They both have a market value, but you don't pay attention to that. What you care about is the cash flows. And the more cash you have, the more businesses or the more investments you can put into the business, which then gives you more cash flow.
Exactly. Beautiful thing, isn't it? That compounding effect.
That's exactly what we're talking about in these portfolios.
The compounding effect is significant, right? When you build a snowman, you start with a snowball and you roll it in a compound. That snow compounds on there to where you got this huge thing. And depending how big you go, it might get super unmanageable, right? Well, and same thing can happen with money. And you can't compound investing in growth stocks, speculation stocks, gambling stocks. It's gambling in that way, but you can compound with dividends and income. Well, if you're just joining us, you're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is, what does your gut say? And we have a paper that we'd like to put in your hand that will help you with this stuff, and what you need to know about income, investing for income, what you need to know about investing for income. And we'd love to put that in your hand. Just call us at 800-725-7616. Ask for the paper on income. All right. And, Daniel, excuse me, people have a hard time making the shift from this speculative kind of thing. There's common stock that have dividends, and that can work. That can work well if you have the right mix, the right balance, the right diversification of it. The things that are kind of on the crazy side are those speculative things. And so many times, excuse me, people with the stock market, they are invested in the stock market, they're more doing gambling than they are investing. Robert Kraft of the Patriots, right? He is investing in his football team, and what makes the difference between him and somebody playing FanDuel? Well, FanDuel, it's gambling. They have no chart, they're guessing at stuff, and they don't have any control. But Robert Kraft, he can choose his general manager, he can choose his quarterback, he can hire and fire whoever he wants. He has control on it. Excuse me. Same thing with Warren Buffett, right? When he buys a company, he has control on that company. Excuse me. But with mutual funds, when people are buying mutual funds, they have no control. It's more like gambling. And so, are you investing or are you gambling? And do you want to, and again, what's the definition of investment? Being paid, being paid. And that's what people need to take the step on and diversify. And it's so hard for them to do it, but once they do it, they love it. And I just see it over and over again, where people come in. I'm thinking of Bob and Sally that they came in and they recognized that they were getting closer to retirement. They needed to change some things and get ready to be able to have retirement income. It's going to be a couple of years before they did, and so they did. They trusted us, and they were waiting. Then COVID happened, and their chickens got skinnier, but their eggs were coming in, and so they hung on, and now they're retired. At least he's retired. And they're just loving it. They say, we don't know how you're doing this, Andrew, but we love what we're seeing. We got all this income available to us, and so it's a beautiful thing. They love it, and they just love seeing those numbers come in.
Yeah, it's such a reassuring thing when you see that money coming in your account. And people have a hard time wrapping their heads around this. We've seen it over and over. We talk to people all the time. They come in, we see them, and it's a difficult thing to get at first. But then once you see it happening, you see how your returns compound. And then when there's blips, or like right now we're talking about rate hikes in the future, and markets are selling off and fixed income selling off, and people are pricing in 7 rate hikes and these crazy things. We've seen this time and time again, right? It sells off, and the Federal Reserve, they're not going to be able to get to raise all these times because there's too much debt, right? People talk about raising rates to break inflation like they did back in the 70s. And that's a different time, a different place. Inflation, they raised the rates above inflation. Okay. So to compare that, we'd have to raise rates to 10% to do what they did in the 70s to stop inflation. 10%.
And we can't. Right.
We can't. If we raise rates to 10%, almost every company in the S&P 500 would go out of business because they have so much debt they wouldn't be able to afford their debt. The U.S. government, we're already running $1 trillion of deficits.
Right.
Their entire, all tax receipts wouldn't cover the interest payments.
Right.
So we're not going to do that. So it's a sell-off, and it's an opportunity for people who have the right mindset, who are prepared, and who were prepared for this, right? Where you have cash coming, you're getting paid the whole time, but now you have things coming due. You have stuff that's up.
Yeah.
We got a story about that stuff that's up, so that you're able to take advantage of things that are out of favor. And that's how a diversified portfolio works. Diversified doesn't mean you own 500 companies in the S&P. Diversified means you are always owning things that are doing well and paying you, so you can rotate into other underfavored sectors. And that's how you can mitigate risk.
Nice. Well, if you're just joining us, you're listening to Financial Strategies with Andrew and Daniel Agemy. It's time for us to take a break. But before we go, we want to give you a little gift that we have for you, a book by Howard Marks, co-founder of Oak Tree Capital Management. And this is called The Most Important Thing. And we think that you'll enjoy that book, and that will be educational, have great educational value to you to be able to understand what people do and how, multi-million-dollar managers, billion-dollar managers and whatnot handle money, and how that you can have that available to you as well. So call us at 800-725-7616 to get your copy, your free copy, no obligation of okay, just draw a blank. The Most Important Thing by Howard Marks at 800-725-7616. Thanks. We'll be right back.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Dad, you know all the bandwagon and the story stocks that have happened since this pandemic started, right? The story stocks of we're never going to have in-person meetings again. We got to buy Zoom because there's only going to be Zoom calls from now on. Or we're never going to go to the gym again. So buy Peloton. Peloton, everyone's going to have a bike inside of their house, and we're just going to ride on our bikes in our house. And all these, there's story after story, and these things are crashing like crazy. And there's some entertainers on TV who are supposed to be stock advisors, but really they're just helping people trade. And that's not who we want to work with. That's not who we're helping. But what happens is they jump on these things usually late, and then they ride up, and then they crash, and then they get out, and then they move into the next thing. And that's not diversification. So if you're trying to hop on the bandwagon, you want to do that with a tiny portion of your portfolio, Go do it. You want to do it with all your portfolio? Go do it. That's fine. That's not what we're talking about. That's not what we're into. We're helping people protect their risk. But the point of this is rotation, right? And you want to be positioned ahead of time for when these guys rotate into the next cool thing, or now it's time to get safe. You're already in there and you benefit from them rotating into the stuff you've been sitting in getting paid. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Listen to our show, and you'll be able to know things that others don't and be able to make wise and smart decisions. So today, our topic is what does your gut say? And this crazy things that are going out there in the stock market, in the world, in the economy right now, and you need to be prepared for inflation, prepared for the market going up, prepared for the market going down. And that's the things that we're trying to address today. Daniel, thank you so much for your indication with that and telling us about those story stocks, these stocks that have a story behind them, and that's why people are buying them. But the problem is the story fizzles out in the end, right? And but the key is front running things and that's where diversification comes into play. And that's what happened with like that Hercules stock or bond that you had talked about. That's what's happened with, we've done a lot with BDCs, and BDCs, business development corporations, have outperformed the S&P in 2021, and looks like they probably will do in 2022 as well. So that's a beautiful thing, right? But you have to jump in and get involved now, so that you're in position for when that next wave happens, that you can take advantage of it. And that's what you're doing with our clients' accounts, right?
Yeah, we. A true diversified portfolio means, first, when you're in retirement, you need to get paid, right?
Right.
You need to get paid. We said an investment actually means you get paid. Now we could talk about purpose for performance all day long, right? And that's, you got to get the purpose first, and that's what we're talking about. So if you want to invest in some speculative stuff after you've got your purpose together. And what we mean by that is not the portfolio value as much as what you need to live off of to have a comfortable life, to maintain the lifestyle you want. So if that's $100,000 a year, then you need to get the money set up to generate $100,000 so that it doesn't matter what's going on in markets, you get paid.
That's nice.
After that, you can look for those growth, those speculations, but know that it's speculation. You can't go buy Apple or Tesla or any of these things and not say that this is speculation. It's because Apple's at these crazy multiples, Tesla's at these crazy multiples. Like, call it what it is, right?
Right.
So just know what you're doing. That's an important thing. Just know what you're doing.
Right.
But get that purpose set up, get paid what you need to get paid. And then if you're going to go invest speculation, invest in something that can be a 20 bagger, a 10 bagger, something that will really give you some returns, right?
Yeah.
And that's why we've talked about Bitcoin, especially because this has the potential to do that as a monetary asset, right? The perfect store of wealth. But that's not what you're living off of. That's the speculation bucket.
Right.
You got to get your purpose done first. That way you can maintain your lifestyle no matter what's going on. But the way you do that with diversification is you invest in different asset classes that react differently to different market environments.
Yeah.
That you're always getting paid from the TR, total return, is made up of income and growth. You're always getting the I in the equation. But then the G comes because we're finding companies that have amazing cash flows that are undervalued. Just like people thought Hercules had a problem because there was some stuff going on with the CEO. We got those bonds down at a discount. And then they bring the chief investment officer in as the CEO, and they go back up over par, right? This is a highly, highly rated company. That's what we're talking about, is you rotate into those. So now in this stock international dividend portfolio, as people are seeing inflation, there's inflation problems, there's energy crisis all around the world, there's this lack of investment in these different industries, and some of these tech giants might be at high valuations. The entertainers are saying, you got to move into these safer things. Well, guess who's already in these and benefiting from the story, the news stories, right? Coming into these investments. That's what we're talking about diversification of portfolio.
Nice. Well, if you just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, what does your gut say? And we have a paper that we'd like to give you that might help you understand these things a little bit more, which is called What You Need to Know About Income. So just call us at 800-725-7616 and ask for the paper on income. 800-725-7616. Dan, you know what I would really like to have you talk a little bit about before we just have a few minutes left in our show today. And, the whole thing that we're trying to do is bring stress-free retirement to people. I can't tell you how many times that I've talked with people and they're so stressed out. We're able to work with them and calm them down. Just yesterday, met with two different sets of clients that were very said to me how happy they are and how stress-free they are, and how their money has bothered them between RMDs and what they were going to need to do, and that they're able to be stress-free with that. So there's strategies that are involved. There's understanding that is involved with what we're doing to make sure that we're addressing people's needs. But then there's also the investment aspect of that. Just hit upon maybe a little bit briefly in regard to that international portfolio that we're doing and why we're doing that and how that works.
Well, in order to get true diversification, you have to be in different asset classes. And the S&P or the NASDAQ is diversified through companies.
Right.
They're all U.S. companies. They all react the same to the same news.
Right.
In general. And then again, you've got 7 that are really pulling along those indexes. So when you've built up wealth, right? Typically people build their wealth by being very concentrated. Okay.
Right.
And then once they have their money, they've built up the wealth, and they decide that they don't want to work anymore. They want to retire. They don't want to have to be on their cruise and worry about what the stocks are doing or what their portfolio is doing. Then they go and they diversify. They diversify into hard assets, typically things that have good intrinsic value and that will pay them. If that's land, if that's good dividend paying stocks, if that's bonds, there's all kinds of stuff. If it's a football franchise, right? They diversify into these things that will generate them income, and they don't have to worry about watching market fluctuation day to day. And so this international portfolio for the people who want it is a way to get mixed in with the rest of their stuff to get 5.5 to 6% dividends and interest, but it's designed to benefit from inflation. So you're collecting your dividends, it benefits from inflation, and it also is an underinvested sector. So just like in Japan, when there's a little garden in the embassy, right, that was had a price tag on it more than all of the property in California. Their markets were crazy overvalued in the 80s, and all money from around the world was going in that markets because it was doing good. Well, that's the same sort of thing. I'm not predicting that we're gonna have a crash like Japan did at all, but just like Japan's market hasn't recovered from the 80s, you want to look at the things that are not what everyone's investing in, but the things that can protect you, keep your volatility down, right? But the most important thing with these is knowing that the company's generating plenty of money to pay you.
Right.
And owning that company so you don't have to worry about what other people are doing if people are selling out. Like the demographics, the whole investing into these indexes and demographics and why that has worked so well over time. We could have a completely different conversation about that. If people want to know about how demographics affects indexing, we can have a conversation offline about that. But like the demographics and what's happened with the the richest generation, right? The baby boomers, one of the most successful generations, going into indexes, and how that's going to be happening in reverse as they retire and start living a different type of lifestyle.
Right.
Is something that you need to have on your radar and get in position to benefit from that instead of doing what has worked in the past.
Exactly. Good. Excellent. Excellent. What one of the things, to put it simplistically is, what I like to explain to people is that, you need to be able to have somebody to, you get up the mountain of retirement, and you get to the top of the mountain, it's got snow cap covered mountain, and when you're up there, do you really want to come down in a 2-seater sports car? Would you rather have a all-wheel drive SUV driven by professional driver that's been there before and be able to have guardrails that will keep you on that mountain without falling off? And so that's what, to summarize all this stuff in a little bit more simplified way is recognizing that be able to have, don't try this at home. Yeah, get somebody to be able to help you stay on that mountain and drive you down in an all-wheel drive SUV. So thank you, Daniel, for that. And if you just joined us or finishing up here, you listen to Financial Strategies with Andrew and Daniel Agemy. We're glad that you've been with us today. I hope you enjoyed today's show and learned a lot. And to help you educate yourself more as we go, we like to give you this book by Howard Marks, The Most Important Thing. You can have that by calling 800-725-7616, easy read book. And I think you enjoy that. If you have any interest in today's topic, 800-725 for your free copy of The Most Important Thing by Howard Marks. And so until next time, you too can have a stress-free retirement.